Most people think that the Securities Exchange Commission, otherwise known as the SEC, exists to make fundraising harder. More rules, more friction, more reasons to stay small. But there's actually one regulation that does the exact opposite, and it makes raising capital easier than ever. And I'm not just talking about millions, but rather hundreds of millions of dollars or even billions of dollars. And I first discovered this rule while working at BlackRock. And later, I used this exact same framework to build a firm that went from zero to over $1 billion in under 5 years. And what's crazy is this rule completely changes who you're allowed to raise money from and how you're allowed to approach them, yet many operators avoid raising capital simply because they don't even know it exists. So in the next few minutes, I'm going to break down exactly what this regulation is, how it works, why it's completely legal, and how you can use it for your very next deal. So here's where almost everyone goes wrong. When people think about raising capital, they default to the most common SEC rule structure without even realizing they're making a choice. And that rule is called 506B. Under a 506B offering, you can raise from up to 35 non-accredited investors along with an unlimited number of accredited investors. Sounds pretty flexible, right? But is there a catch? Well, I'm glad you asked because yes, under 506B deals, you are not allowed to advertise. That means no public marketing, no podcasts, no YouTube videos, and even no social media posts. Everything has to come from your existing network and word of mouth between them, which means that your capital ceiling is capped by how many wealthy people you already know. Now, compare that to 506C rules. 506C deal structures remove non-accredited investors entirely from being an option, meaning you can only raise money from accredited investors. But in exchange, you unlock something that changes everything, which is that you now are legally allowed to publicly advertise your investment opportunity, meaning you can go out and market, you can educate, and you can attract capital from people you've never met before. But the trade-off with this deal structure is verification. With the 506B deal that we talked about earlier, you don't have to verify that investor is in fact accredited. As long as they tell you that they're accredited, then you've satisfied your legal obligations. But with a 506C offering, every investor has to be verified as accredited by a third party, typically a CPA or an attorney, and the way they typically prove their accreditation is by showing that third party their tax returns, financial accounts, or similar ways that would satisfy the requirements to be considered an accredited investor, which, if you're not familiar, means that they must have a net worth of over $1 million, excluding the value of their primary residence, or they need to be earning at least $200,000 a year in income if they're single, or if they're married, that number needs to be at least $300,000 a year combined. Now, most people hear about the third-party verification requirement and they panic, but here's what they don't realize. That verification step is actually a helpful filter and not a burden. When I switched my deals to 506C, everything changed. I went from grinding for months just to raise a few $1,000,000 to raising over $10 million in a matter of days. And that wasn't because the deals magically got better, but because rather the rules of engagement changed. With 506B deals, you end up chasing capital, but with 506C deals, more often than not, capital comes to you. And this clicked for me because of what I learned at BlackRock. I saw over there firsthand how institutions don't raise money by hoping the right investor shows up, and instead they build systems. They educate first, they qualify early, and they only spend time with people who are already capable of deploying capital. And the verification requirement does that automatically. It filters out unqualified prospects so that they never make it to your calendar. And that frees you up to focus on what actually matters, which is building trust with real investors. With 506C offerings, you're allowed to create multiple educational touch points. You can share things like market insights, deal breakdowns, and strategy explanations, which are not about building hype and not about pitching, and instead, they allow you to demonstrate real competence and reliable stewardship of capital. Because sophisticated investors don't invest after just one conversation. They invest after they've seen how you think. And this is also why 506C structures have opened doors to family offices and institutions that I never could have accessed through my personal network alone. Because they don't respond to cold emails, but they do respond to systems. Now, here's the part that most people miss. Having a 506C offering doesn't mean you're blasting out investment terms on Instagram or Facebook, but it does mean you can publicly talk about your strategy, your deals, and your thesis as long as you're following the rules. And the only hard legal requirement is that investors must be verified as accredited before they invest. That's it. This same standardized frameworks that billion-dollar funds use is available to anyone that's willing to learn it. Yet most operators leave millions on the table because they still believe that raising capital is limited to friends, family, and referrals. And that's exactly why most people watching this will finish this video and then go right back to cold calling their uncle to beg them for $50,000. While institutional operators quietly and effortlessly raise millions of dollars from strangers using what I just showed you. But here's the warning you need to hear. If you try to implement a 506C deal without understanding the compliance requirements, you can get yourself into some serious trouble with the SEC. And this isn't something you can just guess your way through. That's why I offer to personally walk people through building a 506c system the right way, one that actually attracts qualified capital while keeping you fully compliant. There's a free strategy call link below this video if you want help setting that up properly. So understand this, the difference between these two SEC rules isn't just technical. It's the difference between having limited capital access and accessing unlimited capital. 506c is not magic, but it's also not a loophole. It's the same framework that major institutions use, just scaled to your respective deal size. You don't need to be a licensed broker-dealer, and you don't need a massive reputation. You just need to understand the rules and build the system correctly. And when you do that, this regulation makes it possible to raise capital for people that you've never met completely legally. Now, what I showed you today is just one piece of building a real capital raising machine. Most operators out there fail because they're so obsessed with finding the perfect deal instead of mastering the process that can actually fund every deal. So whether you're buying your first property, scaling into larger acquisitions, or launching a full fund, the bottleneck is always the same. And that bottleneck is knowing how to access capital. And that's exactly what I help people solve inside of Money Raising School. This is where I show you how to build a complete system that tracks investors, structures deals legally, and scales your business way beyond what your personal network can fund. So if you're ready to stop being constrained by your own savings and start growing your investor capital, then book a free strategy call below. And if you want to see how this 506c framework applies to building an actual fund, then watch this next video, which talks about how to start a real estate fund from scratch, step by step.